China's growth stall will keep global disinflation trend intact rather. Now, this I think is also very interesting. So let's take a minute here just to address China. China is slowing substantially. China generally grows at a rate of 8 to 9%. It is expected to only grow at a measly 5%. However, that expectation was propped up based on what we saw in Q1, which was relatively propped up on services spend and pent-up demand spend. And as that fades, China's economy might not grow at 5%. It might not even grow at 4%. It might grow at closer to 3.5%. That could actually put downward pressure on commodities. You could look at futures for iron ore, copper ore, and see exactly those industrial metals slowing down. It also puts downward pressure on oil. Oil prices certainly way lower than individuals have expected. We're back down to pre-Ukraine war timeframes for oil prices. And while there's talk that OPEC is once again going to cut production, they just haven't announced that yet. And so the oil market so far has not reacted terribly positively to this idea that, oh, yeah, definitely more cuts coming. Instead, more focus for oil pricing and inflationary pricing is focused on China. And this negative outlook for China, as much as it's bad for Chinese individuals, it's absolutely fantastic for the globe, because what you're doing is you're literally flip-flopping what people expected. Now, this really excites me because you talk to me about flip-flopping, I get excited, okay? But think about this for a moment. Last year, markets had this expectation that was fallacious, but they had this expectation that, oh, as soon as China ends COVID zero, we're going to see this massive inflationary boom, and China's going to contribute massively to inflation. Commodities are going to skyrocket. Oil's going to skyrocket. Manufacturing inflation is going to skyrocket. Everything's going to skyrocket because of China. China's reopening is going to cause this massive reinflation. Instead, what you had happen in Q1 and into Q2 here is this, okay, China just kind of went back to normal for the first, 5 months of 2023. But now what are you seeing? And you're seeing this consistently in reports from UBS, Goldman Sachs, Barclays, Morgan Stanley. I read these reports regularly. What I'm seeing consistently in all of them referring to China, I'm just giving you a quick bottom line here, is they're all talking about a massive slowdown in China. In fact, Wall Street today, via Bloomberg, discussing, quote, this is likely to continue for the time being, given the situation in China. After another false start, China's outlook has taken a negative turn. Real estate activity continues to decline. House price growth is low. Yields have started to fall again. Imports have dropped, all reflecting stagnating demand. The typically surefire sign all is not well in China is when capital outflows pick up. And guess what? That is exactly what appears to be happening. Rising outflows of capital once again in China. People trying to get out of China. And a lot of the wealthier folks in China tend to move their money over to wealthier districts such as Singapore or otherwise, Hong Kong. But China's clearly in a slowdown, which is the exact opposite of what economists were projecting at the end of last year. And I remember saying that on this channel too. I'm not trying to pat myself on the back, but I made it very clear. I thought this China's going to reactivate inflation was just complete bullcrap. And sure enough, it ended up being complete bullcrap. Now we're getting this complete flip flop. I mean, look at this. This chart right here shows you capital outflows from China, and how you're seeing more capital outflows from China. With this over here is the outflow gauge. And while you had a recovery during the reopening and you saw less outflows, less of a negative number, we're now going more negative again. Falling again implies rising capital outflows. It's crazy. Or maybe it's not. Maybe that's kind of to be expected. And maybe this is why you shouldn't bet against America. This is why at the end of last year, when everybody's like, oh, Kevin, I want to invest in Chinese companies, I'm like, the only exposure I want to Chinese companies is via American companies. That's it. That's the only exposure I want. I will not invest in Chinese companies. I don't trust Chinese companies because I don't understand China. I don't understand their accounting. I don't understand their books. I don't trust their books. I'm not interested in China with beyond how I would trust American companies to go figure it out. And that's not to say all American companies are angels. It's just to say I think they're more angelic. Anyway, so if reserves are not growing despite China running a large trade surplus, this tells us capital outflows must be leaking abroad. This also explains the yuan's depreciation. The fact that China has not been leaning against the weakening currency tells us that they are allowing it to decline as a pressure valve to decrease capital outflows. China's slowdown will keep the pressure off global commodity prices, therefore, allowing global disinflation to continue. And then, of course, there's always got to be like the clickbait part for the article. However, watch for signs when China is likely to re-stimulate, potentially in a flood-like manner, a sign for when the disinflationary trend could reverse. In other words, if China turns on the money printer again. Yeah, I mean, I suppose it's entirely possible that China could turn the money printer back on. But yeah, again, investing in China is not the most exciting idea right now. In fact, you have more of a risk to a downside in China. Though, again, much like we talked about stimulus potentially coming to the lower income cohort in America, you're likely to get more stimulus in China. However, remember the history of inflation or stimulus in China. China tends to stimulate property developers and corporations, not individuals. Here's another piece in Bloomberg talking about European stocks with high exposure to Chinese markets are counting on further policy support from Beijing to reinvigorate their gains. The trouble is, the prospect of major stimulus appears poor. Since the Lunar New Year holidays in late January, baskets of European shares with sizable income from the country have lagged behind the Stoxx 600. The Euro Stoxx 50 generates 1/4 of its revenue in Asia. This is pretty common of a lot of American companies as well, like NVIDIA. 1/4 of its revenue is actually specifically from China. Certain sectors China has become a vital source of demand for, such as miners and tech companies. Some tech companies relying on China for as much as half of their revenue. Among industrial, auto, and luxury spending stocks, the share is around 15 to 30%. And almost all of the latest data points or indicate rather that China's economic comeback is sputtering. Yes, this is exactly correct. But again, it's not a bad thing. If you are here in America or in Canada or in Europe, you should look at what's happening in China and say, thank you. Thank you for contributing to global disinflationary pressures. That is good. That is a good thing to avoid a tighter Fed and a recession. Remember, folks, Jerome Powell does not want to force a recession if he does not have to. Right now, it does not appear we need a recession to get inflation down. Yes, it is possible that the Fed has over-tightened. So far, we're not seeing indicators that is true. So again, yes, it's so funny. Again, somebody left me this comment the other day, and I don't know why it's bothering me so much, but they're like, "Oh, well, you're just a permabull," and I'm like, "I was the first finance YouTuber to flip-flop. I flip-flopped so freaking fast. People are like, you couldn't possibly have flip-flopped in the span of 48 hours." I'm like, no, I did, and here's why. I mean, I went on multiple interviews explaining why I was so fearful of what was coming and why I flip-flopped. And nobody wanted to hear it. But yeah, I mean, unfortunately, it wasn't popular to be a bear now. It was not popular to be a bear in January of 2022 when I was a bear. Now, ironically, it's not popular to be a bull. People are more bearish. It's just like, to some extent, though, I kind of like that because, if you're doing what everybody's doing, you're probably doing it wrong. That's just the contrarian point of view, though. So it's not always the case, but it's one of the indicators. So anyway, this China slowdown, fantastic again for inflation. Here's another piece, actually. What is this? China is rolling out the red carpet for global business leaders like Jamie Dimon and Elon Musk. That's true. Both of them just talking in China and pitching how great China is. Even Apple, like, we're not trying to decouple from China. We're just putting a little bit of a production somewhere else. Chief executives from JP Morgan and Tesla both met separately with senior Communist Party officials this week against a backdrop of tumbling Chinese markets and disappointing economic data. This was another thing I talked about as well. China, people are like, oh, China's going to, punish Tesla. No, they're not. When you look at the Chinese, the South Chinese Post, whatever it's called, I look at I have their iPad app. I look at them every day, almost every day. I think it's funny because it's pretty much Chinese propaganda written in English. It is a Chinese sponsored news website, state sponsored, and I love it because it basically tells me what the Communist Party of China thinks, and they basically just get on their knees for Elon Musk. And I'm not trying to be offensive. I'm just trying to be realistic. They use Shanghai as a bragging right because think about it. If you could go to Apple and say, look, we know you guys are going to India and you think you want to set up manufacturing infrastructure over there. How about we also get on our knees for you and help you build a new factory over here in China because we really need it. What can we do to convince you to get over here? That is the kind of stimulus that I expect China to continue with. Not people stimulus, company stimulus. If you want corporate welfare, China. Members of the Chinese powerful Politburo also sat down with executives from Starbucks in recent days, with top ministers welcoming leaders from investment firms and other semiconductor firms. NVIDIA, Jensen Huang, also made CEO, also is heading to China this month, according to people familiar with the matter. He was just in Taipei. Flurry of engagement comes after an espionage probe into expert consultancies used by firms to operate in China, spooking foreign investors. But Xi Jinping calling on protecting industrial security as a priority of priorities. Okay. Nervousness around anti-foreigner sentiment comes as China faces a sluggish post-pandemic recovery, reporting weak manufacturing and export data, as well as a property slump. Geopolitics has also made investors wary as U.S. President Joe Biden leads a global campaign to block China from high-end chip manufacturing via the CHIPS Act. Though Joe Biden did recently talk about this cooling potentially coming in relationships or thawing of relationships coming between China and the United States. Makes you wonder, can Biden go to China? Like Nixon goes to China kind of thing. Foreign direct investment, FDI, in China has also plummeted, with investors pulling $30 billion out in the first quarter. And that's foreign investors. We have more outflows when you look at even just individuals within China. The MSCI China index is down more than 50% from its 2021 peak. Chinese stock market not doing that well year to date either this year. And this resumption of global business leaders engaging in person with Chinese officials is reminiscent of a friendlier era, really from before the pandemic and this 3 years of isolations and lockdowns. You've also now got political leaders like Olaf Scholz of Germany and the ECB president Ursula von der Leyen using recent trips to China to press Beijing on hard topics such as territorial claims on Taiwan. This is actually kind of important. Now, a lot of people think China is going to invade Taiwan. China has got an economy to worry about, folks. Their economy is not strong enough to invade Taiwan. And while they might wave the saber, so to speak, they would absolutely destroy their global standing, and they'd become ostracized like a Russia. It'd be so stupid to invade Taiwan. And I know that makes for good clickbait, but it's just nonsense. It's not something that I build into my forecast as a base case. I could be wrong, but it just seems nonsense, especially with the position China's economy is in now. They remember what they talked about in their Chinese Communist Party Congress, which happens every 5 years. They literally talked out of both sides of their mouth. You can't make this up. They're like, I'm going to paraphrase here. Capitalism is great. We still believe in socialism, but capitalism is actually really nice. Socialism is great. Don't worry. We still believe in common prosperity, but capitalism. It's actually a great thing. You could read the translations of the party Congress statements, and you'll see exactly what I'm talking about. I find it very interesting. So that gives us an update on China.